Well, hello, friends. Back to our second part in our investments strategy. We're going to look at, in this lecture, investing in stocks and bonds. So we're going out of the banking industry and into the market. So obviously, we are going to increase our risks and hopefully increase our returns. Why do corporations issue common stock? Well, if we were formulating a business and it was a pretty good size idea, we needed to get some capital, some money to fund our business. We have a variety of ways to do that, but if we are in the corporate form of business ownership, we would issue stock. Stock is ownership in an organization, and common stock is what rules the day. It's a form of equity. So the corporation does not have to repay the stockholder for their investment. This is the risk that the stockholder takes, that the company will do well. I don't have to buy back the shares. The good thing for us as stockholders is we do not have to go back to the organization to sell our shares. We can sell it what's called on the stock market, and there's several stock markets depending on what the organization is funded. So that is our common stock. Common stock vote. These are the stockholders. So the more shares that a person has, the more votes they get, and of course the highest stockholder owners, you would say, are on the board of directors. Well, how would you make money? How? By investing in common stock. Well, you get money from dividends. Okay, the company can pay dividends usually on a quarterly basis. They could pay it in cash. They could pay it in additional stock, which is nice because that has some different tax treatments. Of course, they could just give you some of the company products. That's usually for a startup company. Generally, it's cash and additional stock. Of course, more than that is that the company does well, and the law of supply and demand, other investors want to own a piece of that stock. And so the dollar value appreciates. You buy it at $10 a share, and it goes up to 20. You've doubled your investment. Pardon me. Also, a stock can split. Happens when the shares owned by an existing stockholders are divided into a larger number of shares. We'll look at stock splits here as well. Now there's another type of stock called preferred stock. By definition, it gets a preferential treatment. They get bigger dividends than the common stockholders, and they get them before other common stockholders are paid their dividends. If in event that the company goes bankrupt, generally speaking, you pay back your creditors first, you pay back your banks, bondholders. Anything left over goes to preferred stock. Preferred stock does not get to vote, so these are not, they don't vote in the strategies and the basic vision of the company. They're just like investors, kind of between the common stock holders and the bondholders as well. Usually that's what you're in for. You get a much better dividend, and you know that before you even purchase it. Years ago, Warren Buffett bailed out Chrysler during the first recession that we went through in 2008, 9, 10. Put about $5 billion in and got a 7% dividend, 7.5% guaranteed for 5 years. If we only had a few $1 billion to invest, we could be like Warren Buffett. Risk and return, my friends. Very high risk here. So we're going to get higher returns. Obviously, we're making nothing by having that money under our bed, and we're not making much more just in a bank account in today's times. And so this is where we need to look at, at least going out of those traditional areas and going into some higher risk and return. So just let us know. So in order to mitigate some of our risk, we need to do a lot of research. Remember Socrates, assume we know nothing and learn as much as we can. And of course, you need to learn it in the industries that you might want to invest in. Some of the classifications, and again, the book is very good at detailing these out. Blue chip stock, those are some of what is considered to be some of the best companies. You think of Microsoft, Apple, you think of IBM, you think of General Motors, etc., etc. Again, that's just historical. It doesn't mean anything in the future anymore, does it? You have cyclical stocks, defensive, again, that just goes on business cycles. Growth, income, large cap, those are very large organizations. They've been capitalized over $10 billion. Mid cap, small cap, micro cap are companies that are up and coming. And there's penny stocks, again, that literally sell for less than $1. Be careful on any of these. You need to conduct your research because there's a lot of people who would be happy to sell you any type of these stocks, and you need to be able to have enough research to combat any questions. Why invest? Well, there's great psychology. Great psychology in everything we do, from what we purchase and certainly in how we invest in the stock market. Since 1926, that's 94 years, stocks have had positive gains in 69 of 94 years. So that's pretty strong. Since the same time, they've had negative gains in those 25 years. Since World War II, we usually look at that as modern day era, I think, that the stock market has averaged, if you take all the years, we're at what, 50, 60, 70 years here, we've averaged 10% annual gains. So that's a nice number using the rule of 72. 72 divided by 10, basically every 7 years, your money is doubling in the stock market. Do have to have patience here, but that is certainly a number we would like to attain in our investing strategy. We're going to have to go through all these videos to figure out what's the best way to do that. So, again, you do the diligence. Got to evaluate each investment. You really want to become an expert. If you're going to put your money here, you want to become an expert on the company that you want to invest in. You know, an expert's expert, so to speak. Analyze the finances. This is just basic business acumen here, my friends. Trends in sales, profits, dividends, the product line, the organization, is it changing with the marketplace? And today that is so important. What are new products that are being created? We could take Sears. Sears was one of our best companies for 100 years. We could take Kodak, the Kodak Corporation, one of our best tech companies, and solid gains for, again, 100 years. Where are those two companies today? Yeah, they're buried. Again, what was their product line? Let's look at Apple. We're maybe have some Apple fans in here. Again, how are we responding to the marketplace on the products being created? You know, really know that industry so you can understand and feel confident of the investment that you make. Consumer confidence is huge. You know, the economic environments, the business cycles, inflation rates, interest rates, consumer confidence, I think is very strong because we are a consumer-based economy. 70% of our economy is based on what we spend. And so if consumers are not confident and of their own income and their own purchasing patterns, that they want to hoard and save their money versus spend it, that tells us a lot about some of the organizations and what may be coming down the road, so to speak. The biggest thing I can say, if you are going into single stocks, and this is something you want to do, and almost any investment, is your patience. Do not overreact. There are things that are way beyond our control that happen. Stock market dropped down in this 2020 year in March and April and May to about 18, almost 17,500 points. Everyone thought, oh, there it goes. You're going to lose all your investments. And I knew personally kind of people who were restructuring their 401ks, their IRAs. They were getting back into money markets and staying there. And hey, I don't blame anyone for doing that, but I did think it was too late. You needed to make that move 6 months in advance. If you think things are going down, make your move early. Don't make it when everyone else is making it, because now it's back up to 28,000. It's hit almost 30 again, almost to its high, and so those people lost an opportunity to gain that money back. So don't overreact is the best thing. When everyone is losing their heads and blaming you, that's Rudyard Kipling there. Keep your patience. Things will come back. Now, again, the money that we make, you may be sitting on holding stock, maybe your parents, grandparents, people the dividends. A corporation, if you are now an owner, once you own stock, you are a very small owner, could be a very big owner. Depends how much stock you have, but that's how we pay our profits in the form of dividends. Generally, they are paid quarterly. Again, they could be paid cash, or they could say, you would get a cash dividend of X amount, but we're just going to reinvest that in more stock. And that gives you some better tax advantages. Again, these are things that you want to know before you purchase. And so, but dividends are very important. That just means the company is healthy, it's profitable, and they're paying back their owners. So that's something to look at. If we were to take Apple as an example, Apple pays 75 cents on average per share. So whatever number of shares you have of Apple stock, they pay 75 cents generally 4 times a year. Of course, you're really getting Apple stock because you're looking for the appreciation of that value. And that's what we want to look at. It's called the buy and hold strategy. And that is you buy your stock, you hold the stock, and then you hope to sell it at a higher price. Okay? If I had to go back in history, in the 90s, Apple was literally left for dead. That was Michael Dell. He said, let him die. Because they didn't have any direction. Steve Jobs was not there, and the company just could not make the products that people wanted. And it was the PCs that ruled the day in the early 90s. Well, Steve Jobs did come back, got a plan. Bill Gates himself invested $1 billion into Apple. But even up until 1997, the stock was $3.56 a share. I can remember at 95 being right about $3 a share. And why didn't we all purchase then if we were there? Well, again, the entire industry said Apple's gone. At $3, you're just wasting your money. Well, if you purchased $1,000 worth of Apple in 1997, you would have $632,000 today. Now, that doesn't mean every stock did that good. But again, that's our goal, is to buy it low and sell it high in a buy and hold strategy. Now, you may be able to take advantage of stock splits. This is what happened in Apple's case as well. Sometimes the stock price just goes too high for an organization. Some of Berkshire Hathaway stock, that's Warren Buffett's organization, sells for over $100,000 a share. So that's kind of hard for the average investor to buy into. Now, he has different series of stock in his organization. But if it gets too high, the corporation can say, you know what we can do? We can split the stock into a lower price, and that may attract in more investors because, again, organizations are always looking for more capital so they can fund and finance their projects. So let's just look what happened this year, in the year 2020 at least. Apple got to $400 a share. They like their stock around $100 a share. So on August 28th of 2020, Apple declared a 4-for-1 split, which means if you owned 400 shares before the split, okay, your value was $160,000. Now it splits, okay? You now own 1,600, so it was a multiple of 4. The value is still the same. You just have more shares. And of course, I believe Apple's stock from the 90s to the current day split at least 3 times. So, and then again, the value went up. So I think you can see how you get to that $600,000 pretty quickly. You basically, I don't know what we have there, 4, 4, and 4. That's basically a multiple of 64 times your stock that you've had if you bought it in the 90s. So that's something nice, but that's what a stock split is. It's the same value, you just get more shares, and you hope that increases. So right now I believe Apple stock is somewhere around, it varies, but about $130 a share within the month that it's split. Where do you get this information? My friends, there's so much out there. Again, look at all the personal information, personal finance information websites that I have out there, and that link for you. MSN Money is great. Yahoo Finance is great. The New York Stock Exchange. There's really no limit to the amount of research you can do. And back in the day, you had to literally go to a library and get out a company's 10K report and look at their financial structure, and that was not a lot of fun. You can look at almost any organization that's traded publicly on one of the public stock markets and look at their strategies. This is how you do your research and your due diligence. Well, what will we look for if you're looking for buying into stock? Well, a good place to start is corporate earnings for an existing company. Okay, it plays a large part of the increase or decrease of the price. If we have a company that's earning or at least projected to earn well, we could look at Tesla, which has really never made a profit for the entire year. since its inception, but now all signs are pointing that it can be very profitable in the years to come. So we look at corporate earnings, and the best way to look at that is earnings per share. This is the corporation's after-tax income divided by the number of outstanding shares of the common stock. And so the price per share ratio is that price per share divided by the earnings per share. So let's look at some of this. There's Apple again. There's the great Steve Jobs, left us too early. But you can see where that stock was much earlier, even in the 90s. And, again, this was their first big split, was right about, I think they had a split here and a split right up in here as well. This was a 7-for-1 split. This was a huge split in 2011. So, as we look at Apple, we look at earnings per share, okay, after-tax income and outstanding shares. And Apple, just using some rounding up numbers here in 2018, they had a $60 billion after-tax income. That's all after tax. That is ginormous. They had 20 billion shares of stock outstanding, common stock. So the earnings per share is $3 per share. Okay, obviously, if that's a positive number, okay, and if it's a larger number there, but positive, that's a healthy sign. So we're looking at signs of the financial health of the organization, and we would expect Apple to be profitable. We would expect Amazon to be profitable. So let's look at the price earnings ratio. Okay, you see, this is another number to look at. That means the price of the share of stock, okay, divided by the earnings per share. So in 2018, Apple was right about $60 a share. And you can look at how fast this thing grew, because it was at 400. And so, is Apple still a good stock to buy? Well, that's up to you to look and research. But it's a very strong core company, probably America's strongest company. Price earnings ratio, again, now the price per share by the earnings per share. So we take the $60 per share, we take the $3, okay, that was the earnings per share, gives us a PE ratio of 20. Okay, well, there's another number for us. What does that really mean? There's Tim Cook, all right, CEO of Apple. So the price earning ratio means this. In a nutshell, investors are paying $20, okay, for each dollar that Apple earns. Just so we know right in there. So I'm paying $20 for each dollar that Apple earns. The industry standards, and again, this is just historical information, basically that good buys are somewhere around $20 to $15 per share. Basically, it's like 10 to 15 times your earnings. So basically, investors are paying 20 times the earnings in 2018. Now, in 2020, at the end of the year, the price earning ratio for Apple is estimated at 36, which means we're paying 36 times earnings. Okay, all right. Well, everything that we've talked about has been historical, right? Because we're not soothsayers yet. And so we're just looking at averages. Now, this gentleman in the background here is Peter Lynch of Merrill Lynch. Back in the 70s, when he made his billions of dollars, he was always looking at projected earnings and said, I don't want to look at the past, I want to look at the future. So it's another tool for us. So in evaluating stock, we want to know what the projected earnings are of that organization. So price earnings to growth is called the PEG ratio. And again, explained very well in your book. Price earnings ratio divided by your annual earnings per share growth rate. This number helps us. It's really evaluation. And that's what he liked to say. I want to buy companies that are undervalued because I think we can get a lot more stock appreciation. And so when these numbers come out, you're going to get a 1. You're going to get over 1 or under 1. Anything less than 1 should mean that a company is undervalued. Anything greater than 1, he believes, that company's pretty much at its maximum value, if not overvalued. So let's look at this. Super easy here. Here's a earnings per share, PEG ratio. Here's company A. Well, their price per share is $46. Their earnings per share this year is $2.09. Last year, their earnings per share was $1.74. Okay, so let's see if we can find the ratio here. Well, the PE ratio we know is basically your stock price divided by your current earnings per share. That gives us the number 22. Okay, and that number meant what? That we are paying 22 times the earnings for this company. So for every dollar that company A brings in, we're paying $22. Okay, now if I were just to pop over to company B, if we were to do that calculation, they're $80 a share. This is their earnings per share this year, $2.67. Last year was $1.78. So if we just looked at PE ratio alone, we would say that number is 30. Okay, just again doing the basic math. So we're paying 30 times earnings for this company. Off the top of our heads, we'd say, well, wow, I think company A may be a better buy because we're paying a lot for their earnings in company B. And that's where Peter Lynch said, we've got to get something better than that. I got to find out what the growth rate is. So if we look at the growth rate, well, that was this year, $2.09 earnings per share. Last year's $1.74, so we're getting more this year. That means it's growing. So we do this calculation, 209 divided by $1.74. This year's divided by last year's. And then we just minus 1 so we can get a percentage. And that gives us a 20% growth rate. So earnings growth rate is 20%. So the PEG ratio is your PE ratio, all right, the 22 divided by your growth. So 22 divided by 20 is 1.1. Now, Peter Lynch said anything 1 or above is probably overvalued. Well, let's look at this one. This had the bigger number here, which means we're paying more. Okay, we're paying 30 times earnings, but their growth rate is 267. That's this year's earnings per share versus last year's earnings per share, $1.78. Again, let's get the growth rate minus 1, 50%. Okay, so this company's growing faster. Now, when we do this ratio, the 30 divided by 50, 0.6, that's well under 1. So this tells us that company B is really undervalued because they're growing so fast. That gives us a little more insight, doesn't it? Now, again, everything looks beautiful in a mathematical computation. But there is the real world that affects it. So this just gives you something else to look at. Again, read through your book on this. This kind of helps you, but the PEG ratio is important. It's a lesson to learn here. If you can find a company that's undervalued and has good future growth, I mean, you may have the ingredients for a really good investment, my friends. Now, this is as good as your research is. If you do this haphazardly, if someone, hey, tells you about it, you got to recheck. You got to do that great research. And you got to know that industry. You got to know exactly everything that you think is going to happen. And then you make your best guess and go forward because there's no sure deals. As you progress in your financial career, so to speak, your personal finances, and then you talk to a financial planner or a broker and they say, man, I got a sure deal. Here's exactly what I do with your money. Hang the phone up, shake their hand if you have to, and then run away as fast as you can because there is no such thing as a sure deal. You have got to do this. There's the man. Now that's Warren Buffett, considered to be one of the greatest investors in American history. And if you read what Warren says, it's pretty basic Omaha, Nebraska mentality. His investing philosophy was, you know what, look for industries that he understands. For years, he did not invest in the tech industry, all the way through the early 90s. And he said, hey, IBM, Apple, some of these other companies, they're really good. I just don't understand them. And so I don't feel comfortable in investing. Look for the industry that you understand and look for very good companies. And then now we know how to look at a little bit of valuation that he looked at that he believed to be undervalued. Because price is what you pay, the value is what you get. And if you can start building your portfolio with undervalued organizations that have good growth rates, again, that's where we get that appreciation happening. Well, how do you start buying stock? Friends, you can, again, There's full service, there's discount, there's online brokerage firms. You can certainly set yourself an account up. Again, go to MSN Money, go to Yahoo Finance. You Google up how to buy stock and whatever you feel comfortable with. Obviously, the full service, what they're trying to sell you is what we've just talked about. They say we look at the research, we do all these number crunching, and they should. I mean, that's what they do. Where you don't have to worry as much. The discount, again, you make your decision and someone makes the order for you. The online firms are basically that you are setting yourself up an account and you're depositing your money into that account and then you're buying your own stocks. And so these are some of the questions that you want to ask. And again, you'll find this in your book. They're going to charge fees. They've got to make money themselves in commissions. And so basically these are the lowest commissions right in here. Full service is very high commission. We're talking somewhere in the 8 to 10% range. These are in the 5%. This is probably in the 2% range. You're getting what you're paying for. I'm just not telling you which one you should do, just trying to give you the alternatives that you can choose from. There's a bull market and a bear market. Don't think one is better or worse than the other. The bull market basically means that we believe we're in a recovery, in an expansion stage, and we're doing well. The bear market believes, because if you look, a bull attacks upward, a bear attacks downward. That's the saying that of why. It is more of a recessionary time when things aren't going so well for companies. You can certainly make money in both areas. When the market went down earlier this year, or any year, sometimes it goes down. It went down in the recession time of 2008, 9, 10, 11, and it went down in the early parts of this COVID-19 in 2020. People were still making money. And so how does that happen? Well, you need to know a few stock transactions. And again, this is where your research comes in. You can do a market order. And this is really what you do with your full service. You say, you know what, I would like to buy this stock at this price, and I want to sell it at this price. Okay? So you put your orders in, and then it automatically does that. You can do a limit order, which means, again, I'm only buying or selling at the prices that I like. Okay? You can do a stop loss, which a lot of big investors do. Again, the full service brokerage firms helps you out with this. You may very well be able to do it with the online broker, with your online account. And that just says, if my stock that I bought in XYZ company drops more than 15% in a given period, then I want to sell it at that price. I don't want to lose any more than that. And so that's your stop loss. So you don't lose any more money. Can you sell it short? Yes. When you believe, and this is very risky, and so I'm just giving you the anecdotal version here. But again, when we saw the stock market going down to 17,000, okay, it went down to 6,000. It went from 16,000 to 6,000 in 2007, 8, and 9. I think it bottomed out somewhere around 2010. People were still making money. So let's say, as an example, you believe that a company, you've done your research, and you say, you know, something's wrong. This company's not going to do well this year. I don't believe at all. How can I profit off that? How can I bet off that? Do I just sell all my store? Should I buy into it, or should I buy short? And so you get with a broker. Now, you would have to go to a brokerage firm on this, and you say, I believe that ABC stock, okay, is going to go down. So they arrange a deal where you borrow the shares. And for this example, we'll just put 10. You can put as many zeros out there as you'd like to. And so now you are the short seller. And so you sell those. You borrow the stock, and now you sell it at $500 per share. You had 10 shares. Okay? This is what the market does. You believe the stock market is going to lose value. Okay? And it does lose value. So now you buy those 10 shares when you think it was at the lowest price, which means you think it was going to lose money. It was at $400 a share. And so, you know what? That's what I thought it would do. I'm now buying those shares. So, when you buy those shares, you have now returning them to the broker. And since it went down $100, okay, you had 10 shares, you basically now have $100 profit. Now this could have been a $1,000 profit, it could have been a $10,000, $100,000, $1,000,000 profit. That's what selling a stock short is. You're betting that the stock is going down. You find someone, again, a broker that will be happy to say, okay, hey, we bet sideways, upways, downways. Now, in this example, let's say the opposite happened. You bought it at 500, okay? I'm sorry, you sold it at 500. You borrowed, you sold at 500. You sold somebody else because somebody else said, "What? I think it's going up, so I'll take your bet." And it does go up. Let's say it went up to $600. Now you owe $100. Okay, even if you have not sold it yet, you're going to have to make up the loss because you're still holding that stock. So it can get very complicated. But again, just because the markets are going bear, all right, they're going down, doesn't mean people aren't making money from that. So that's something that, again, you want to do some more research on. And if you'd like to see how this happens, if you've ever seen, or please get on, I think Amazon still has it, The Big Short. Steve Carell's in it. Christian Bale's in a lot of Brad Pitt's in it. A lot of actors are in it. It was really a good movie, and it was based on truth that how a group of investors, different groups, saw that the housing market was going to explode. They got in very early, and they bet that the entire housing market was going to go short. And for years it didn't, but they still held on to their investments. And when it completely crashed down, I mean, they started buying, making these agreements in 2003, 2004, 2005, and they literally shorted the market and made billions of dollars. It's just an interesting way of seeing how money moves in down times. So that is a little bit on stock investing. You can get, again, if we look back from World War II, we know that the market gives us about a 10% increase. Now, again, you got to pick the right stocks. So that's something to understand as we go into our investment strategies here. Now, next, we are going to look at investing in bonds.